Hey, welcome back to the live stream. This is Victor from Victor H Investing, and we're going to do a live stream to go over the economic data that's been out this week, where the market's currently trading, and look at some of these earnings that have come out in the last, let's call it 4 or 5 trading days. There's been a lot of earnings, a lot of good information to review, and we'll take a look at any stock that people on the channel want to take a look at as well. I appreciate you joining the Quags, I guess is the handle. Thanks for joining. Just a quick reminder, this channel, I share my individual experience as an individual investor, and I hope you find it interesting. It's not financial advice. I don't recommend you buy or sell any stock that I cover. It's something that you want to weigh carefully and make your decisions wisely on that. So with that, let's get started. Let's take a look at the markets really quick. So first, so looking at the S&P, it went up 0.91%, and it was really good to see that. I've noticed that there is still fear in the market, and I'm going to point to a few stocks where they had, I don't know, you can interpret it and think, I think there were good earnings, but the stocks just sold off. There was just something there that investors didn't like, and boy, it was sold off. I think there's a lot of like tension or anxiety in the market. People are really afraid that something bad's going to happen. The Federal Reserve came out yesterday, and they didn't move rates. They didn't lower rates. They didn't raise rates. But he did go as far as saying that there will be no rate increase, which was telling the market the only way we're going to go is down, but we're going to hold. We're going to stay where we're at for longer. Understood. So that was, he communicated something to the market there. We're going to get a employment report tomorrow. That'll tell us what I guess the economy is doing. I'm hoping that unemployment's not a big problem. I always like, everybody wants an economy where people have jobs. Everybody wants to work, goes to work, makes an income. That's all good. So we'll see what happens there. Earnings have been coming in, to the positive. I think I listened to some credible resources. I think in the last live stream, I was asked, some channels that I follow. And I forgot to mention that I do listen to Tom Lee. I think he's pretty good. He's a pretty strong bull. He's always saying, oh, it's a bull market, it's a bull market, it's a bull market. But he does bring, a lot of good information to what he shares. And he's stating that, hey, most companies are coming out with favorable earnings. They're beating on earnings. So that's always good. So I think this year is going to be kind of a moderate, gains this year, but there will be gains, and setting up for the next couple of years that should be good. I think some companies like Apple, that I'll get into in a few minutes, I think Apple's beginning to lap, meaning their comparisons, because companies tend to be compared to what they did 12 months prior. And Apple was growing and growing and growing, then they stopped growing. So it's like, oh no, they're not growing anymore. They actually are going down in revenue. Well, once you get 12 months after that, and we'll see it in the Pfizer numbers when I show those, your comparison looks more favorable. Hey, you grew compared to the same quarter last year for the same quarter, Q1. And that has, if anything, a psychological advantage when a company reports that way. And I'll show you a few examples of that. If we keep doing that, where we have some companies that have the toughest part of their compares behind them, then they're probably going to rally. So I'll show you a few examples of those. All right. So it's good to see you, Sergio. Thanks for joining. Quags, good to have you. So it's Quags saying you can You can just call me Quags. Cool. I had to misspell it to add it to the make a YouTube account. Okay, cool. Sounds good. And then Sergio, very nice to see you. You're a regular. I really appreciate your support of the channel. Keep the questions coming. Looks like Apple is rallying. I did buy into Apple carefully. I'll show you my position, how much I've invested, where I'm at with that investment. We'll see if they hold the I think they're up 6%. We'll see if they hold it tomorrow. All right. So the conditions in the market, one last thing. I like to, if anything, just kind of sense, where's the market going? Is it going to rally? Is it, overpriced? And if we look at the prior month, we're still down 2.72, which is good. It's kind of like, hey, let's not get overly greedy. Let's make sure that, prices on stocks for companies that are overpriced get beaten down. You saw Super Microcomputer, which is a high-flying stock, to say the least, get really pushed down on price, even though they came out and announced great earnings. That's great, but the price is too overheated. So it's good to have downward pressure for a while. A month isn't enough. It'd be nice to have it go for a couple months, take it down like 10%. Then I would really feel like, okay, we hit a pretty good bottom. Now we can rally from here. This could be a little bit of a slight rally that we're seeing here. That's going to be followed by another, dip. If we get some negative news, if we get some bad events, maybe if the war, escalates in Israel /Hamas /Iran, something can take us negative. Is that bad news? Overall, first, a war would be very bad news for the bloodshed and the deaths. But relating to the stock market, it'd be good news, bad news. The good news is stocks will be discounted. The bad news is stock prices are coming down. So we got to have the internal fortitude to just realize, okay, our portfolios are going down in value, but we get to buy awesome companies at a better price. So we'll see how things play out. It's an, interesting time. I think the earnings have been good. And if they keep coming in favorably, it should keep us, if anything, going sideways. All right. So what I wanted to do is go over a few companies, starting with Pfizer. And so Pfizer. Now, one of my experiences in life, I think I talked about this on the prior live stream. There was hey, Quags, man, thank you so much for giving me $4.99. That is awesome. Thank you so much. And I'll take a look at EDR and TKO. Really appreciate it. So I'll finish my thought on Pfizer and then I'll move to those. So as I mentioned to a new investor, I forgot her name. I think it was a lady by the name of Janet. And she asked, hey, any advice you would give a new investor, somebody who's kind of learning? And the short answer was, hey, one of the things that I really encourage you to do is look at the areas where you have experiences and then pick those sectors maybe to begin with, because you have industry experience, maybe a job, maybe family members have been working in an industry and you kind of have some inside information on that. Okay, so back to Pfizer. So one of the jobs that I had was at a pharmaceutical device company, and I was actually a controller. If you know what that is, that's an accountant that manages the entire production facility. I did all the capital expense models. I did all the accounting at month end for a pharmaceutical device company. Went through all the cycles of doing the drug discovery, which is, these scientists trying to figure out a drug that's going to help somebody with a particular disease, going through all the motions with the FDA, and then finally getting the ability to commercialize and sell that drug. I did that for multiple years. Having said that, that's why I like looking at pharmaceutical companies and healthcare companies, is that I have that experience, plus I get to look at other companies. And when I look at Pfizer, I look at a company that has a lot of established drugs. They have these drugs and they have a patent, which is an automatic moat, or a barrier from other people copying that drug and saying, "Hey, I'm going to sell the same drug that Pfizer's selling that's under patent. That's not allowed." Those drugs are very valuable. And the issue that Pfizer had was that they were dealing with the fact that one of their successes ended up being a big liability. They came out during COVID and had one of the vaccines, and all of a sudden they sold something like $80 billion in 1 year of COVID vaccines. That's huge. But what that does is, the following year, when you roll out your revenue, you have to compare to that year. And you're like, okay, oh my God, the revenue is really down. What's going on with Pfizer? And I'll try to show you a revenue graph. So you see how their revenue picked up in 21, 22, and then it came down in 23. Well, investors were like, oh my God, Pfizer's broken. It's going to go out of business. And that's not it. It's that a pandemic is a once in 100 years event. Thank God we got, through it. And I think it's behind us and we're moving on. The good news is that Pfizer got all that cash and they put it on the balance sheet. They acquired another company for $5 billion. They kind of strengthened their company. So I continued to buy into Pfizer and believing that, hey, they're going to have a really good, future next 5 years. And it was good to see that their earnings were well received by the market. It looks like Pfizer gained 7%. It beat on earnings. It beat on revenue because their compare is far more realistic now. They're back to being the Pfizer before COVID. So I'm glad that, my theory, my story that I had on Pfizer is accurate, somewhat accurate. I'm never going to be perfectly accurate, but that stock is working. The other thing I really like about Pfizer is they pay a big dividend. Let me expand this for a second. So their dividend rate is somewhere in the 6% neighborhood. And I think the stock's really going to move. Oh, looks like Google Finance not giving me the chart that I need. All right, well, we'll move off of that. But okay, so that's my story on Pfizer. It was good to see that they had positive earnings. And let's move on to some of these other stocks. EDR. All right, so I'm going to move to my favorite little website here, EDR. Okay, so we're talking about Endeavor Group Holdings Incorporated. And this company, Endeavor Group Holdings, operates sports and entertainment company in the United States, United Kingdom, and internationally. It operates through 4 segments: owned sports properties, events. Okay, the owned properties include Ultimate Fighting, World Wrestling, Professional Bull Riding, EuroLeague. So these are growth sports, by the way. I think Ultimate Fighting it didn't exist 25, 30 years ago, maybe 30 years ago. Now it's like, man, it gets so much attention for good reason. I think the Ultimate Fighting athletes are arguably the most fit and brave athletes on the planet, right up there with bull riders, which is also a sport that they cover. I love watching bull riding. And then EuroLeague. Okay, good stuff. So it's an interesting company. They've done, wow, the stock's down. Okay. Stock's down over 5 years. Man, look at that big dip. What happened? Do you know, Quags, what happened here? If you want to put it in the chat. Yeah. EDR is parent TKO. Cool. TKO, yeah. So that's interesting that the price has been dropped a lot. So they pay a small dividend. Okay. Market cap of 8 billion. Revenue is 6 billion. And forward P is 16. Nice and low. And I think that big dip was when they bought UFC. I mean, I'm not an expert when it comes to this industry, but to me, UFC is really valuable. It gets a lot of attention. The pay-per-view. I think UFC, again, not an expert, just an observer, is taking all of boxing's income. What people used to pay in boxing or buy, pay-per-view boxing. I think UFC is taking a lot of that revenue. It's also taking away from, professional wrestling and that type of fanship. UFC is pretty interesting, especially some of the bouts. So, all right. So the stock is, so the growth is really good on their revenue. 13 billion. I'll maximize this. So they grew 13% in 2023. Cash flow looks like they have about $165 million of free cash flow. In 2022, more cash flow, like around 350,000. And then in 2021, more cash flow. Maybe it was that acquisition that they made. It consumed some cash. It looks like operating activities consumed a lot of cash. Looking at the quarterly, I don't get any more data, so I'll go back to annual. All right, so they make a little bit of cash. The dip in cash, we got to look at it, or I would encourage you to look at it and see what happened. Is it a one-time event? It's nice to see growth in free cash flow. Okay, and even if you have a growing company, they should be growing their free cash flow. If we look at the forecast, we have 12 analysts cover this stock. That's a good number. And everybody's saying the stock's undervalued, that it's discounted. The average is that it's discounted by 11.36% based on what those 12 analysts are seeing. The high, somebody's very optimistic at 32%. So let's take a look. Earnings per share is expected to be $1.64 in 2024, move up slightly in 25, really jump up in 26, really jump up in 27. So this thing's kind of a good long-term hold idea. And fundamentals look good there. So just looking at the way that I would do the cash flow on this, by the way, I wouldn't take the last year because it's too low. You see how they were doing from operating cash flow. They went from 161 to 333 to 500. That's what we want to see. You're going higher, higher, higher. The COVID year, I'll give them a pass that they went from 397 to 161. These are live events. The government didn't allow you to have live events. Totally understand that. But once you got out of that year, it started to grow, and then it dipped. Okay, what happened? So I would make sure that there's no business problem, like, oh no, for example, they're in this big lawsuit and they can lose $5 billion, or something's wrong with the business. As long as nothing like that exists, I would actually take probably the average of these 3 years, and I'd probably grow it by about 10. And that would be my starting point for free cash flow. And then I'd put it into a valuation model. So I'll put it into a valuation model real quick. I think the last company I have on this is Chegg. Okay, so we're going to value this company from scratch. So it is EDR Endeavor Group. All right, the discount rate on this company, see how Chegg is a small company, it's 10. It's much higher than, let's say Meta, that's 7.5. And that's because I want a better return because it's a smaller company, more risk. So I'm going to go with 10. All right. I'm not going to update my growth numbers. I'm just going to kind of go into this very quickly. So we decided, okay, or I should say I decided I'm going to take the last 3 years and I'm going to average this this cash and determine what the average over the last 3 years of free cash flow has been. So it's going to be 393 million plus 502.93 million plus 333 million minus, I'm going to take away the capex. So minus 227.76 minus 143.93 minus 77.81. I'm going to divide that by 3. So we get to 260. Now, with investing, it's art and science. The science is you're looking at the data, but you have to make a decision, right? A good business decision. Is this company growing? Absolutely. The dip in free cash flow, I would misrepresent the free cash flow because I would say, oh, well, this company only has 165 million free cash flow. No, it has more cash flow. To go real conservative, I went with the average over the last 3 years. So put that in there in my notes. Average over 3 years. And then I'm going to grow it by 10% because these guys are growing. I could see that they're growing, and I'm going to multiply it 10 times 10%. Now, from a growth perspective, let's go back to the income statement. They grew 46% coming out of COVID, so I'm not going to look at that. But they grew 3% in 22, 13% in 23. Very good. So I'm going to grow those free cash flows by 10% in years 2, 3, 4. Terminal value, I'm going to grow at 5%. So they just acquired some businesses. What I really like about this company is that they are focused on similar businesses. Bull riding. You got people showing up to an arena. They're going to see an event that's spectacular. I mean, watching a guy get on a, I don't know how much they weigh, but these bulls are massive and angry. That's amazing. Then you have UFC fighting, which is amazing. So they have this experiential business and they're really focused around those topics. That's really good. They're probably going to grow these brands globally. And you might see bull riding in other countries. You already see UFC in other countries. UFC is a total global sport. You have athletes from Europe, from different places in Eastern Europe. You have athletes from Latin America, athletes from the US. I'm sure you're going to see a lot of Asian athletes come into UFC. So I really like that focus around the business. So I like the business. So I think they're going to be growing well. So once we grow those free cash flows and we have a terminal value, which is all cash flows beyond year 4, discount rate of 10%. My model, and this is a net present value of all these streams here. Okay. And if you want to take a tutorial on YouTube of how to calculate net present value of an income stream, you know, that's how I got there, is a net present value calculation. All right. How much cash does this company have? So cash equivalents, cash and cash equivalents, 1.4 billion. So 1,445,000,000. What kind of debt are we dealing with? So we go to our debt. Current debt's 135 million. And then we've got total debt of 5,392,000,000. So, okay. So I'll put that into debt. Okay, so our total debt's 5,528,000,000. Equity value of the company based on that is 1.9 billion. Sorry, guys. Their current market cap's much higher than that. It's 8 billion. So I think what is not working is this cash flow as the beginning. I think it's too low. I'd have to get into the company. do your homework and really establish a better free cash flow starting point, because I think we're misrepresenting it, but it just doesn't fit my model. So I can't really value it really well here. The shares outstanding, 301.98 million. Yeah, the value per share that I'm getting out of their free cash flows, if I start with 286, is only $6 per share. So it shows it as a premium of 76%. So obviously that's not good. Looking at earnings per share, their earnings per share are expected this year to be $1.64. It is a growing business, so I'll go with a 24 PE, a growth rate of 10%, and it has a share price of $43, where the current stock price is $26 a share. And that's why I do two different methods. You see how one method really showed the companies like, wow, man, it's a huge premium. And that's because their cash flows, they're in a period of time when they're acquiring businesses. This is a good opportunity if you really study this company, if this is your industry and you really like this company, it's an opportunity to buy at the right time. And then once they start generating the cash flows that they're probably going to generate, the stock's going to double, triple. But for now, this thing doesn't fit the models very well. It doesn't fit my model. And that's what I ended up with. So, all right. So that's a quick valuation. What I would do with a stock like this is probably move on. It's like, okay, this is probably maybe a year away from it being ready for prime time. And it's not in an industry that I really know. So there's not a lot more that I can do. All right. So the other company was TKO. Versus TKO, sorry. So TKO. So TKO is market cap around the same. Revenue, 1.6 billion. Forward P of 48. Tiny dividend. Okay, strong buy. Wow. Take a look at that. Okay, so over the last 5 years, wow, it's come up recently. If we look at the 1 year, it's wow, look at that. So we had the stock a year ago was trading at $104 per share. Now it's at 95. Volatility in this stock, you can see that it's really gone up from about 73 up to 95. If we look at the revenue of the company, revenue has been growing really fast, especially in 2023. That looks good. Cash flow. See how much more cash flow they're generating. 468 minus 48 is 420. $420 million of free cash flow. And last year they did roughly 490 million. And the year before they did 430 million. So it feels, I feel confident about their cash flow. They've been making really good cash flow and they've been growing their business. This looks really good. So this company looks far better because the other one had that 1 year that had a down year for cash flow. Analysts, 12 of them cover the stock. On average, they say it's 15% discounted. The high price target's $131 per share. They're trading for 95. Okay, looks good. And then their earnings per share is expected to be $1.86 this year. It's going to grow a lot and then grow a lot. Wow, this stock looks good. And TKO, I mean, I've heard of TKO. I'm not a big boxing fan, but I've heard of it. So let's do this one very quickly using the same model. Remember, 76% discount, premium, and then 63 discount on earnings per share. And heck, let's just copy that guy. All right, so TKO. And what's the name of this company? So it's just TKO Group. Same discount rate. It's a smaller company. I'm not going to do these calculations just yet. The growth rate, this company is growing real nice. I think their income statement really shows that. So 10%, yeah, that's good. I'd even go like 15 because they're showing really good growth. 46%, 10%, 15%. Looks good. All right, so free cash flow, 468 minus 48. Let's go with that. Okay. Now I'm going to do one more thing, which is I'm going to increase that by the growth rate that we are putting on this stock, which is 1.15, representing the 15% growth. So now this stock, and this is going to be 2023 times 1.15. Okay, so first 4 years are growing at 15%, and then long-term growth of 5%. And intrinsic value, all those cash flows, 11.4 billion. Let's look at their balance sheet. Balance sheet, cash and cash equivalents, 235 million. Total debt, $3 billion, 27. Okay, so the equity value is 8.6 billion. Market cap of this company is 7 billion, 690. Shares outstanding, 80. Those are low shares, 80.6 million. Okay, and then stock price is $95.33. So based on their free cash flows and a pretty high discount rate, the stock is discounted 13%. And that's after the stocks run up from mid 70s up to mid 90s. So that looks good. Okay, now let's look at earnings per share. And earnings per share for 2024, it's expected to be $1.84. 24 PE since it's growing. The growth rate on that PE, it's really going to go up. You see that? It's going to double, almost double. And it's going to go up there. So I'm going to go with 25% growth. And the earnings per share doesn't support the stock price yet. I mean, I could actually go like 30% because it's growing so darn fast in these years. This stock is fairly priced. It's pretty close. You see how it's a 5% premium. And what we're probably dealing with on this one is, we're a little late to the party. If we had looked at the numbers and believed in them, we would have gotten a nice discount here. Now, one of the things that I do is once I really like a company and I see that, hey, there's good volatility in this company, I'm like I just wait. I wait, and then the stock drops. And I've done that with Starbucks recently, and I'll show what I've done on Starbucks. But you wait for the stock price to come down to where it's discounted. I think this is a quality company. It's growing, but you just don't want to overpay for a stock. This one here, and that's where it ended up. So hopefully that helps, Quags. All right, good stuff. So just a couple more notes on that. Okay. Good to see you, Teutonomy. All right, so Teutonomy's got a comment. Hey, Victor, what have you done with your Starbucks and CVS stocks? Do you buy some more shares? So yes on both. Let me look at both of them. And CVS, I did a video on, and I think it went out this morning, so you can look at the detailed analysis that I did on that. And that's part of like what I'm seeing is like certain stocks, when they get sold off, they just get sold off huge. Like, look at this sell-off here. It just fell off a cliff, right? So you would think, wow, well, the earnings must have been terrible. And no, not really. So if we go to CBS Investor Relations and we go to their earnings, so the revenues increased by 3.17. That's good news. The earnings per share was lower than what was expected. That's bad news. They generated free cash flows. That's good news. So high level, the quarter was not terrible. They guided that they're going to restate their financials and bring them down from earnings per share. They're bringing it down from $7 a share to $5.64. So my point being is that, okay, this was not an A plus earnings report, but it wasn't terrible. And it's certainly, I don't understand how the stock collapsed like this. This is CVS. These operate pharmacies, healthcare payer. They operate health services, like these little urgent cares in their facilities. This is a really good company. If you look at their financials, growth. This is a sign of a quality company. They continue to grow their business. Cash flow. Cash from operations is really good. It's been dipping, so that is a concern. But you look at the free cash flow they generate, it's just really high. And they pay a nice dividend. It's up to 4.8% on CVS. Looks really good. And if you look at this volatility, I mean, that's incredible that they got dropped so much. So I bought more shares in CVS. I think CVS is going to be worth more. If you look at the 5-year chart, they were priced at $109, $110 a share. They are half off now. They're down 50% on a quality company that has proven that they're going to be around for a long time. So that's my comments on CVS. Starbucks. So Starbucks, they've had a really nice peak. This was like in the go-go, post-COVID year. They were up at $126 a share. They dipped down with everybody else in 2022. They rose, and now they're down again. And they're down pretty hard. If you look at the last 5 days, look at this drop. And again, you'd think, wow, man, what's up with this drop? Did they all of a sudden, are they going out of business, or what's the story there? Again, as we look at a business like this, you look at quality growth. Now, this year in 2020, I give them a pass. COVID, you couldn't open up retail stores. Okay, so if you can't open up retail stores, your revenues dip. But then the following year, they came back and grew 11% growth, 11% growth. Very good. The earnings that came out, they didn't grow their sales if you can compare this quarter versus last year's quarter. The compares are becoming really difficult for Starbucks. They grew a lot in 21. They grew a lot in 22. They grew a lot in 23. You remember all that stimulus money that we were being given? Hey, here's however many hundreds of dollars. And and they did it like 3 or 4 times. Well, people were going out and buying lattes. And since you can't spend a whole lot of money doing experiences like movies and theme parks and stuff, people are going and enjoying a premium Starbucks drink. So the compares just get really hard on a company like Starbucks. And it's an opportunity for a value investor to come in and buy Starbucks at a discount. So I'm buying into Starbucks. And why isn't this giving me a chart? Here we go. All right. So we go from top to bottom, down 34% for Starbucks. So yeah, they're having a tough quarter. I get that. And that's great. because a value investor, I'll pick up really good shares in Starbucks. This is the number one company in their category. There's no other better coffee restaurant company in the United States, arguably around the world. You can't compare them to McDonald's. McDonald's is primarily food, and coffee's really profitable. They brew a cup of coffee. It costs very little. The biggest cost, labor, real estate. So this is a business that I want to be a part owner in, and I continue to buy into Starbucks. So that's the answer to your question, Tutomi. All right. So yeah, Extreme Sports is those two companies we took a look at. I think that's a growing segment just because it's so freaking exciting and impressive, frankly. Some of the UFC fighters and bull riders, man, for them to have that courage to do that is amazing. And then some more comments. Stock ticker G. So what's G all about? I think we looked at this stock in the last live stream, and it's got a downward chart over the past year. Man, that's pretty low. We were going from 44 to about 30, 31 and some change. So it's down 28% in the last year and had a really nice rise. It went up 111%. And then it went from there to here, 41%. So what's going on with the business? Yeah, we covered this in the last live stream, so it should be a little bit familiar for me. Yeah, outsourcing services. My conclusion was that this is probably going to be like close to fairly priced. It's not an exciting industry. And the thing I mentioned is that small caps are not getting valued very high. When you look at what's, here's stocks. I'm going to go from, so these are the most valued companies on the market. Microsoft, Apple, NVIDIA, Google, Amazon, Meta, Berkshire, Eli Lilly, Taiwan Semiconductor, Tesla. These companies have been almost like they have gravity. They've been taking most of the increases in the stock market across the board. Small caps have been lagging. So when we look at a small company like Genpact, it's probably going to value okay with this small discount where possible. Investors are not excited about it. Investors are excited about like Google's, Alphabet's kind of had a nice run over the last 30 days. And that's a big name. People get their heads around it. Or obviously NVIDIA, people really get their heads around that. So that's what I would say on Genpact is the fundamentals look good. It's probably going to value decently. It's just a small company. And it's hard to get a small company to really take off unless they're growing. If they're growing really fast, they catch everybody's attention. Or like the company we looked at, TKO, or the other company that does extreme sports, they get a lot of publicity, right? You can't watch sports without knowing who they are. I knew who TKO was. I knew who the other, through their Ultimate Fighting and bull riding, I knew who they were. So there's some recognition there and some comfort level for investors to buy into smaller companies like that. So those are my comments on G. All right. So Quags, TKO, Endeavor, and WD. Oh, they did a 51-49 split, I think. Okay, cool. I think both those companies, FYI, is, you can have an advantage as an investor if you really study them. And that's kind of like something that you think is fun and interesting. And you just get ahead of the curve. You kind of know, hey, this is probably going to happen because I have, an interest in it and I understand it better than the average investor. Because most investors on Wall Street do not get this industry very, very well. And you might have an advantage there as an investor. All right, Shadow Guy. Yeah, I'd love questions on bonds, Shadow Guy. Bring it. I invest in bonds. It's kind of boring, but I'm getting older, and I like buying bonds. Probably a bond that I would put out there is maybe I can show it on my spreadsheet. So I set up a bond ladder. What is a bond ladder? This thing will, a bond will redeem. So at this date, the US government is going to pay me back the $10,000 face value of these bonds on this date. Meanwhile, they're going to pay me this interest rate, which is very low, but I bought them at a discount. And overall, the annual interest is $460. Okay. And my bond ladder is basically, I wanted to, provide liquidity each year. And that's why I set it up. And it has a better yield than if I had it in a money market account. A couple of like really cool bonds that I thought were cool is this one here. This one has a really high yield. And this is an oil company down in Mexico. Mexico has predominantly one oil company. It's nationalized. And when I bought it, it paid basically an 11% yield. And I get to make an 11% yield for like 7 years. Sign me up. It's an oil company. Mexico's economy is doing really well. So in bonds, you can pick up some pretty good investments. And you could also pick up some very low risk investments like Microsoft, right? I'm probably making 5-6% on Microsoft. It's their bond. It's not going to go up or down. I know that on February 12th, 2025, they're going to give me my $16,000. Meanwhile, they're going to pay me $878 in combined interest and appreciation. So that's a defined return. As you get older and you're like, hey, if I retired, I would expect, $102,000 from my bonds. And chances are it's going to be exactly what I get, because few of these companies will go bankrupt. Every once in a while, one will, and you'll have to take a part of your bond value back. But that's what a bond ladder is. I've covered my bond ladder on my channel. If you search for the video, you'd see it. But Shadow Guy, fire away on questions on bonds. All right. So thanks for the question to Tommy Quags. All right, let's talk about UPS. So I covered UPS a couple of days ago. And do I UPS on my watch list? I think I do. I do not. Okay. So I came to the conclusion that I think it's not a good time to buy it. I think the price is too high or their fundamentals are too low. But let me confirm that. You see that they did really well coming out of COVID because everybody was shipping products, and their compares are getting tougher and tougher. And I think the economy for e-commerce and shipping and so forth, I think that's beginning to slow down a bit. And of course, I say that on a day when my wife and I ordered a bunch of stuff for Mother's Day because we were going to have a bunch of people at our house, and 3 giant boxes showed up to my house today. So this is a $125 billion company, revenue of $90 billion. This is a very good company. This is a great brand. This is a great American company. PE, forward PE of 17.8, very reasonable. Nice dividend, 4.4%. Looking at their financials, see their revenues coming down. These compares are hard. Coming out of COVID, you saw where their stock price went. See how they were like growing nicely, 7%, so forth. And then boom, COVID hit, 14%. That's like double their growth rate. Another 15%. And now it's hard because the business is slowing down. The comparisons are harder. And that's what's weighing on the investor. And that's why you see a stock chart go down. Okay. You're still dealing with a high quality company. So that's what's going on with their top line. On their free cash flows, their cash flow came down. They were just booming in 21, booming in 22, just generating really high free cash. But their free cash now is 10 minus 5 is $5 billion. And if we cash flow, looking at 5 billion, I don't know that it's going to be a discounted stock price. I think it'd probably be still priced at a premium. We'd really need UPS to drop from, looking at like before COVID in 2019, it was priced at $119 a share. That would be a good comparison is, hey, before COVID and you got all this additional revenue because everybody was buying on Amazon like crazy or whatever website they were shopping at. If they were lower than 2019, then they'd probably be discounted. But for now, I don't think they're discounted. I think it's a great company though. Good question. Thank you. All right. So starting position is Starbucks and CVS. I bought $1,000 to get started on Starbucks. Why $1,000? It's a good round number for me. I don't buy like some investors and, it's not how I invest. The way I like to invest is, let me look at Coinbase because I'm going to cover that. And I like using Google because it lets me kind of show far more data. So you look at Coinbase, right? Now, cryptocurrency, some people love it, some people hate it. And Coinbase went way down. They went down 90% from their high. And I thought, okay, these guys are the only publicly traded cryptocurrency company in the United States. And cryptocurrencies, some investors like them. Some investors like me hedge a little bit, not a lot, just a little bit. I own $120,000 of Bitcoins collectively. So if they get all the volume with other companies like Binance has really had a lot of trouble. I forgot the name of the company that Friedman just went to prison over. But the long and the short of it is I buy in a range. I started buying coin when it was really just nobody liked it. Everybody hated it. This has outperformed all my other stocks because I buy, $1,000, $200, $300, a couple $100 at a time and continue to build and build until I end up with a position. Let me find my Coinbase position. So Coinbase, I have $10,000 invested and it's worth $26,000. So I buy like that, $1,000 and I buy a couple $100 over time. And I try to find a range when I know that, hey, or I believe I know it's discounted. I don't have to be perfect and say, this is the bottom, or this is the bottom, or this is the bottom. That's really hard. And say, okay, this is where I'm going to put $10,000 into Coinbase. To me, finding that one day is really hard, but seeing a range where the fundamentals are like telling me, hey, Coinbase is probably going to be worth a lot more. Because if they're the only exchange and they're growing their revenue and they do produce free cash flow, they're going to be worth more. So that's how I invest in a stock. Good question. All right, man. Super Loco Taco, GTN. Gray television. This is old school TV. Boy, they're down a lot. So they're down 73%. Okay. And if you watch my channel, Super Loco Taco, I start with, do I believe in the business? And linear TV is getting pretty much replaced by streaming. And even like Alphabet has their Google TV. So they're actually replacing linear TV with a streaming service that makes linear TV viewers feel like they're on linear TV. So these guys are feeling it from all different directions. And if you look at their revenue, you can see that their revenue has been decent, but it's been coming down. The big story around, linear TV is, can you get some value out of it? Potentially. Wow, they were up 7.3% today. That looks good. But over a year, they're down 13.6%, and we measured that big drop. Okay. So I think they're trying to compete next gen TV. They're trying to compete with the streamers. And, this thing will probably value well, meaning you can probably say, hey, the cash flows are worth, X amount. And look at this market cap, 646 million, super low. Forward P less than 2. Oh my God. But investors are just not excited about linear TV. Most investors believe gray television will be out of business. It's like they're just not going to be around in the future. The revenue's been pretty decent if you consider that they've kept it above 3 billion. We look at their cash flow, last full year they generated 300 million in free cash flow. The year before, almost 400 million. You look at their market cap, it's a $647 million market cap. They generated about 40% of the market cap in free cash flow. So this thing, will value. It'll show you that, hey, you're getting a lot of cash. But the problem is that the whole industry is going away. So if I look at it and say, is this a good 5-year investment? No. I don't know that gray will be around in 5 years because they just continue to get replaced. Is it a good 5-month investment? Potentially. If you catch it at a good price, it catches some good news like it just did, you could probably make a good return over a short period of time, but not a long period of time. So good one. All right. Do you consider to invest in Dutch Brothers, possibly competitor to Starbucks? So the short answer, I looked at Dutch Brothers, and FYI, I was in Oregon and went into Dutch Brothers. Nice restaurant. I enjoyed the experience. But I just, looking at the two different businesses, I actually like the Starbucks business more because Starbucks really has it down. Like if you took an industrial engineer into a Starbucks, they'd say, okay, they're doing everything very efficiently. If you went to a Dutch Brothers, they're too much like a mom and pop. It's not really set up for scale and efficiency. That's one of the observations I have. Second is, Starbucks is Starbucks. They're the big brand. They're the big global brand. Dutch Brothers, I know who they are because I was in Oregon and I enjoyed one of their beverages and it was fun. It was nice. But I don't know that everybody's been to Oregon or wherever Dutch Brothers are these days. So I think the name recognition is going to be lacking, and it's, I believe, a small cap. So that's my answer to that. Next one, even Starbucks and CVS are low in price. Yeah, so CVS, I was already an investor, and I think I've got like $15,000, $20,000 invested in CVS. So Starbucks is a new position. I started with $1,000, and then I just buy incrementally, especially on pullbacks. I would buy $500 into a stock, and it really depends on my comfort level. For example, on Alphabet, I've believed over the last 3 to 6 months, if you watch my videos, I share this, Alphabet was being discounted, and part of it was their mistakes. They were getting punished, but I look at the core business and I'm like, that's a really valuable business. So with Alphabet, I would buy $1,000, $2,000. With Meta, I would buy $1,000, $2,000, because those are like really good companies. And I just believe those guys are going to continue to be worth a lot of money. As we go with smaller companies, or maybe companies like Starbucks that are on the mend, trying to fix their businesses, again, I don't know when the stock price is going to be right. The Netflix example is probably a good one to show. And I do Netflix. If you look at a video I did about 6 months ago on Netflix, I told this story. So here's Netflix. They're just flying high, $690 a share. And they came down to this price level. And it's like, amazing. How does Netflix get discounted? So Bill Ackman, the big famous investor, hedge fund man, I mean, the guy's a billionaire. He's brilliant. He bought like $2 billion of Netflix and made a big splash. And the stock kept going down. And then he exited his position, and this thing's blocking me, but close to the bottom, and he's lost $400 million. Well, once we got to this zone, I started to buy. It's like, this is ridiculous. This is the number one streamer. And from the bottom to the top, they're up 212%. Amazing. So, did I want to, like, Netflix at one point, I had like $50,000 invested in it, and I cashed out most of my position there, by the way. I took a huge gain, and I took it around here. Now, do I put it in like Bill Ackman here and then, oh my God, I lost all this money? Or do I start, buying into the stock and saying, okay, over time, this thing's going to pick up, and I could just keep buying shares on pullbacks and accumulate a position? For me, my individual investing, that's what I feel is a better approach, because it's just too hard for me to pick that one day that I should put $25,000 into Netflix, $25,000 into Starbucks. Eventually, could I see myself owning $50,000 of Starbucks? Yes, but I need to get there over time. And if I do that with enough stocks, it's going to work. It works out for me. It works out every year. I make, a very good return on appreciation, dividends, and everything. So good question. All right. SoFi. So I've looked at SoFi over and over again, and the companies that I like instead are StoneCo. They're down in Brazil. They give me a little bit of international exposure, which I like. And these guys, look at this chart. Way back here, they were at $92 a share. Now they're way down here, 82% drop. But that doesn't tell the whole story. If we go, I've been invested in StoneCo, I'm going to guesstimate 2 years. So I started investing like back here, and the stock's up nicely. I'm up on StoneCo quite a bit. So that's one of the investments that I have. So I've invested $23,000 in StoneCo. It's worth $35,000, and I've invested it over time. I'm not buying any more shares because I think the price has gotten higher. And then the other one is PayPal. I've been buying into PayPal. I've invested $43,000. It hasn't been a windfall yet, but I have a feeling PayPal is going to rally from this point. I think PayPal, like Alphabet, was beaten up. I think part of it is PayPal's own mistakes, and the market beats it up. But I kept buying, and now I've got a nice position, and I think they're going to keep rallying. They've had a really nice couple weeks. If you look at their earnings were good. And looking at their 5-day chart, they had a nice rise out of their earnings, and it's come down a bit. But overall, I think they're heading in the right direction. Okay, from the low to the high recently, about 7%. So that's why I don't invest in SoFi. I don't think SoFi generates free cash flow yet, and I'm really focused on free cash flow and earnings per share. So that's why they don't beat out StoneCo or PayPal for my money. And I have Coinbase as well, by the way. So I already covered that one. All right. Thanks for the question, Quags. And then looks like Sergio, you're also interested in SoFi. And FYI, it's my opinion. If you see something different in SoFi, I know that other investors are doing well with it. It just didn't make sense to me. Didn't make sense for me. And but I think SoFi is doing well. Actually, it's going sideways in 1 year to date. Wow. So, yep. Interesting. Okay. Next question. So, Omar, you took a hit on CBS. Yeah, I took a hit on CBS. You got that right. Looking at the last, man, why is Google not giving me data on that? That's nuts. All right. So last 5 days on CVS, 18%. Oh man, beautiful. And I've got $17,000 invested in CVS. So nice $4,500 loss. The biggest loss was Meta. I mean, I've got a lot of money in Meta. And if you recall, they went down like 11%. I think my 1 day loss on that was 20 grand. But they came back a little bit since then. And overall, I'm up big on Meta. So I'm not going to cry about it. All right. Good question. I'm taking a risk on RBLB. Any thoughts? Autonomy. So RKLB. Rocket Lab. Wow, man, what's going on here? So the stock price is worth a lot more. These low stock prices, sometimes they're concerning. And again, to the average investor, what are they seeing? Okay, a concern. Why is the stock price so low? In 1 year, they're up 3%, but it's deceiving. It went up and then it came down. Okay. A $2 billion company. They do about 244 million in revenue. They're losing money. Okay. So they've gone from being a $62 million company to 244. They're not profitable yet. Their cost of revenue is really high. Okay. And this means that they probably have to spend a lot of money on whatever rockets and so forth that they use to probably launch payloads into space. And it's just very expensive. Cash flow, they're burning $98 million in operating cash flow. And then they're burning another 54 million in putting it into the business. So they are burning cash. Okay. How much cash they have left? They have $250 million of cash. Current debt, 17 million. Long-term debt, 160 million. So this is, this is a concern, right? If you're burning $150 million of cash, you got $250 million of cash. So you got a year and a half left of cash. So something better start working or you're going to be bankrupt. There's no way around it. So sorry for the negative speak on this one, but I'm going to give you my thoughts on it. It's just my opinion, not saying you buy or sell it. Thinking about buying Rocket Baba 2. Rocket Baba? Is that a company? Or are you just joking with me? All right. I'm not seeing it. Rocket Labs. Oh. Okay. Yeah, I shared that. So yeah, Teutonomy. They have money for about 2 years. And some of these, so I'm gonna go to SoundHound next, Quags, 1 minute. So here's so I'm a value investor, right? I think as an investor, I want to define, what is my investing approach and why, right? Okay, I'm a value investor because I think the experiences I have put me in a position where I can probably find companies that are undervalued and then I can own them and make a lot of money. Okay. And I could take that and really go across multiple industries. You could see that I invest in multiple sectors. And my experiences over my career, I've done consulting for technology and I've gone across many different sectors. So that's the investor I am. Now, what Wall Street, and I would say like CNBC and Yahoo Finance and all the different media companies, Bloomberg, they love to showcase that one company. Like I'll show you an example, like Intuit a long time ago. software company. Now they're huge. They do TurboTax, they do QuickBooks. Well, they were out of money. They couldn't pay their own people. They were paying people with stock. And the founder was, telling people, hey, if we make it, you're going to be really wealthy. If we don't make it, you're going to have to go find another job. And, good luck. I'll give you a good reference. So that's that story. And when that story, when that company makes it, it becomes really popular, as it should be. It's a great success story. But it doesn't mean that every company that runs out of money is going to do that. It's actually the opposite. Most companies that run out of money are going to go bankrupt. And it's, for me as a value investor, it's important not to get caught up in too many like emotional stories of companies that made it. I want all companies like Intuit or, Rocket Labs or whomever. Hey, I hope they make it. But, the money that I've earned over time, and it's just really, I've worked too hard for it. I want a good return. I want to put it in most companies that are just going to return a very good investment. I'm really willing to take risks, like on Coinbase that worked out. But I think I showed a couple examples where I've lost money. Willing to do that, but not completely, buying all stocks for companies that are unprofitable. All right, let's talk about SoundHound. I looked at SoundHound recently. SoundHound is an AI play. They do artificial intelligence related to sound. They just do not come anywhere near their value based on earnings per share or free cash flow. And I'm going to take a look at them just to make sure that my memory is not failing me. So here's SoundHound AI. So when we look at it, it's a $1.4 billion company. The revenue is only $45 million. They're losing $91 million a year. Okay. All right. And if you look at their stock, they've had a really nice spike recently, but it's come down quite a bit. Financials. So they've grown really nice, but they've gone from like almost zero to 45 million. 45 million is not a lot. You're paying how many times revenue? Like 30 times revenue to buy the company. Cash flow, negative cash. They're burning cash in two ways. They're burning it through their operations and then CapEx. Not a lot of CapEx. Okay. They're probably outsourcing and buying their compute from somebody else. So this one here, I can't do much with it. Negative cash. And then when we look at their forecast, they're expected to lose money in 24 and then lose money in 25. So my models would basically say, hey, this thing isn't worth anything. It's actually has a negative value in my models. Okay. Do I understand enough about SoundHound to feel like I have an information advantage? No. I think there's brilliant people at SoundHound. They may end up being really interesting, but I just don't get it. I cannot understand it, and I'm not going to invest in it. My last question is about AbCellera. Okay, so I invested in AbCellera. It was one of my big losers. And I got out of the position. I just don't see how they're going to have an operating business that's going to have long-term growth. They were fortunate to make a lot of money off of COVID. They had some type of therapy that helped people with COVID. And they had a big infusion of profit during that era because they got a royalty out of it. And after that 1 year, it's just been nothing. So I probably lost 75% of my investment. Not a big one, maybe $15,000, $20,000, and walked away because a loser like that just becomes too much of a distraction. You're just like, oh, I got to look at this thing again. And I like looking at my stocks twice a quarter. And I would look at it and say, hey, here we go again. How much cash are they burning and how much longer before they have a viable product, like line of products that they can sell? It's just nowhere near the current time. So I got out of it. All right. Just compare Amazon. Yeah. So if you go back to Amazon during the dot-com bubble, and I'm sure a lot of you are like too young, but I was in the year 2000, I was 31 years old. So I was front and center. I lost money on some companies, but overall, I made money on others. And Amazon back then, it we weren't sure it was going to make it. It was like on the ropes, but they just kept operating and satisfying their customers, and the rest is history. It's like a $2 trillion company. And but those are two very different businesses. Um, the rocket business, I'm not smart enough to tell you about the rocket business, but the Amazon business, Jeff Bezos was a really smart guy. He understood that we were going from a disconnected world where everybody started getting PCs in the late 80s, but they weren't connected. We were dialing up on modems. It was really slow. We weren't doing exactly like what we're doing right now, where I'm live streaming around the world. I mean, this is like, we couldn't imagine this in 1990, but Jeff Bezos could. He could imagine that it was going to be a connected world and that e-commerce was going to be huge. Good for him. Now, that's a very different business than rockets. I mean, rockets is, you got SpaceX is one of your competitors. A lot of things can go wrong. What if whenever you have these rocket launches and 5 in a row explode? What happens to your business? I mean, that's just a different business. Where e-commerce, it's like, man, Amazon was selling product left and right. They started with books and then they diversified into other products. So two different types of businesses, but it could be a similar story where Amazon really saw the future. For all we know, RKLB is doing the same thing. And 10 years from now, it's like, wow, they're doing all these really incredible things. If that's the case, you understand that, go for it. I don't understand it, so I will not invest. So, all right. All right. Maybe next time we can look at CRISPR. Yeah, let's hold that one for next time. And then looks like some final comments. I'm going to wrap it up soon here. Really appreciate you tuning in. And then Teutonomy. Yeah, SpaceX number 1, and then RKLB is number 2. I think what SpaceX has done is incredible. They're taking over from like NASA, and it's pretty incredible. But it's not a business that I can totally get my head around. Maybe I need to put some more, thought into it. And then I think Sergio's asking about Virgin Galactic. Virgin Galactic, I don't know much about space travel, but I look at that whole concept of, you get taken up by an airplane, and then for a few minutes you get taken into officially space, and then you float around in space, and then you come down and you charge people, I forgot how much, like $300,000 to do that. Yeah, there's probably going to be a list of people that are going to buy a ticket for that, but you're not going to buy it to anywhere near the average person. They just can't afford it, nor do they want to do it. I don't want to do it. I think it'd be too risky. It is very risky to launch into space. Anybody who tells me different, I wouldn't believe. You're going into space, and a lot of things can go wrong. Even though you have the best equipment, the best designs, it could just be some freak accident, and then you expire. So those are the businesses. I'm not going to get into them, but maybe somebody else. It's somebody else's investment, and I wish them well. So it's been a really good live session, guys. Thanks for all the questions. I didn't even get into any of the companies. Well, a couple of companies that I planned to cover, I covered. But more importantly, I kind of just, played off of your suggestions, which is really awesome. I appreciate you guys attending. Really appreciate your support on the channel. Keep the comments coming. I'm having a lot of fun doing it. I hope you're getting value out of it. And I hope you guys make a lot of money, and I hope you continue to grow your portfolios, continue to grow your wealth, and end up in a very comfortable situation down the road. All right, everybody, have a good night.